Financial crises have appeared frequently throughout history. Whenever a market experiences a crash, it is the effect of economic events spurring investors to act out of fear. The S&P 500 just closed at its lowest level in 2022, and the Dow Jones Industrial Average officially entered a bear market. If the Fed's latest announcement, which propelled the current market turbulence, is any indication, things are going to get worse. When will the crash end? How long until we're out of the woods? According to Chamath, it is not happening anytime soon. Chamath Palihapitiya is one of the prominent investors who carved a niche for himself as a result of his special purpose acquisition companies. In a YouTube video, he expressed his claim about the crash lingering for 3 more years, justifying it with seemingly negative factors which have invaded the economy. He directed his viewers to past financial crises and how it is badly managed, thus extending their stay for too long. The current crash is about to take the same trajectory. The financial crisis of 2007 through 2008 was an epic economic collapse that cost many ordinary people their jobs, life savings, and homes. The 2008 financial crisis was initiated by cheap credit and lax lending standards that fuel a housing bubble. When the bubble burst, the banks were left holding trillions of dollars of worthless investments and subprime mortgages. It started with good intentions, just like how the Fed is currently using painful methods to combat inflation. Confronted with the burst of the dot-com bubble, a series of corporate accounting scandals and terrorist attacks, the Federal Reserve lowered the federal fund rate from 6.5% in May of 2000 to 1% in June of 2003. The goal was to boost the economy by making money available to businesses and consumers at bargain rates. However, the result was an upward spiral in home prices as borrowers took advantage of the low mortgage rates. By the winter of 2008, the U.S. economy found itself in a full-blown recession, and as financial institutions' liquidity struggles proceeded, stock markets around the world tumbled the most. In January 2008, the Fed cut its benchmark rate by 3/4 of a percentage point, which turned out to be the biggest cut in a quarter century as it sought to slow the economic slide. The British government was compelled to nationalize Northern Rock, the global investment bank. Bear Stearns, a pillar of Wall Street, collapsed and was acquired for pennies on the dollar. Also, the collapse of Lehman Brothers marked the largest bankruptcy in U.S. history, and for many, it became a symbol of devastation caused by the global financial crisis. The recent crash looks different because nearly all the methods used to quell it have proven futile. The Fed had just announced that a 0.75% rate hike, the 5th rate increase this year. The August CPI, or Consumer Price Index numbers, indicated inflation remained stubbornly high, and the Fed made it clear that it intends to make reducing inflation its main priority, even if it threatens employment. The CIO for Commonwealth Financial Network, Brad McMillan, expressed his opinions about the Fed's decision. "I think we probably are going to be facing a recession, because the Fed has explicitly said that's what it needs," he said. However, it's a vague prediction in what has already been a tough year already for the stock market. Since the beginning of the year, the average U.S. mutual fund, or ETF, has been down 17.3%, and the market witnessed various instances of daily and weekly losses at their highest level since the pandemic. Things are getting harder for businesses and individuals. Investors are majorly concerned about how much worse it can get in the coming months. But we are going to have a mixture of good news and bad news, and probably end the year on a sad note. From Chamath's perspective, it could stay around for a couple of years. With so much in the air, it is difficult for investors to make sense of what's happening day by day. This translates to a volatile market situation, which will last for a while with more Fed meetings scheduled this year. Also, Fed officials may have overcorrected from being immensely optimistic about the economy's post-pandemic prospects to being unreasonably pessimistic about the inflation trade-off. Back in September of 2020, the Federal Reserve officials believed that the downturn connected to the pandemic would be extremely deep and subsequent recovery would be relatively modest. And even under the appropriate monetary policy, the officials attested that Americans would be producing 2.5% fewer goods and services at the end of 2022 compared to what had been expected before the pandemic. The rate of unemployment was meant to remain above the pre-pandemic level until at least 2024. The shocking fact is that things look different now. The latest projections from the Fed are more pessimistic than the ones made before we got the news about the mRNA vaccines. Under appropriate monetary policy, Americans should envisage being 3% poorer at the end of 2023 compared to what had been projected before the pandemic and to remain permanently worse in the years to come. In contrast with the June 2021 projections, the level of gross domestic product at the end of 2023 has been marked down by 5.5%, and it is worse than the hit from the pandemic. It is not surprising that policymakers now expect the jobless rate to rise sharply, from 3.5% in July of 2022 to at least 4.4% before the end of 2023. The Fed chairman, Jerome Powell, noted at the post-meeting press conference that the targeted growth path could give rise to higher unemployment. Powell denied that anyone at the Fed would relish workers losing their jobs, but he emphasized that there needs to be a sharp slowdown in growth and that the Fed officials would accept a lot of economic pain if it meant bringing inflation back in line. It is a good intention, yet heartrending. Furthermore, in situations like this, it is necessary to reflect on the words of economist Milton Friedman, who famously taught about the operations of monetary policy. He vividly stated that the policy works with long and variable lags. By this, he means that it takes time for the Federal Reserve's actions to affect the economy. In that effect, if the Fed waits for inflation to manifest itself before raising interest rates, it would have waited too long to prevent inflation from becoming a real menace. However, the Fed chose to ignore Friedman's fundamental teachings and kept the monetary policy too loose for too long. The opinions of a large percentage of investors are directed towards the fact that the Fed officials were so embarrassed that they missed inflation and prevented it from getting this high, so they are willing to overcorrect and force the economy into a recession. We should brace ourselves for a hard economic landing. Since the start of the year, in response to the expectation of more hawkish Fed, there has been a rapid incline in government bond yields and a sharp correction in equity prices. The 10-year government bond yield, which has had major influence on mortgage rates, increased to almost 3%. The Fed appears to be shifting too rapidly from excessively easy monetary policy to excessive policy tightening. We can now ask, how will the financial markets, who are accustomed to the ultra-easy monetary policy conditions, hold up to a combination of rapid interest rate increase and the Fed's commitment to reducing its balance sheet? Meanwhile, Chamath's claim about the situation extending for 3 more years is a hard pill to swallow. What will become of investors in the economy? According to the founder of In Laws We Trust, Linda Garcia, the market despises uncertainty. The current economic situation is something we can't compare to anything that has happened, certainly not in our lifetimes, she said. Garcia's suggestion was based on the fact that investing is a long-term play and investors should not steer away from their investment plans. History has shown time and time again that the market always bounces back after every wild ride. It could get worse, but this is part of the journey. So far, the year has been volatile, but we should still stay prepared for even more shifting. Add the Fed in the mix, finally raising rates, and then geopolitical issues with the war in Ukraine, which certainly does not help inflationary pressure as far as the oil, gas, and food supply goes. That's all the stuff we haven't totally felt yet. Some of that we're going to feel into 2023. Another expert, Melissa Buchilin, said. Simply put, this means that investors should get prepared for worse, but should not lose their minds. It is hard to predict what will happen in the next few months or years, but it is best to hold on to investments and ride the wave. Cryptocurrencies like Cardano have been adversely affected by the looming factors. Even the influence of the Vassal hard fork has not been felt across the ecosystem. However, it is the long-term play that matters. But of course, what are your thoughts on this? Let us know in the comment section below. We'll see you in the next video, but before then, check out our other videos to find out how Ethereum is carving out its niche of being the Ethereum killer. And as always, make sure you click on the subscribe and notification buttons.